A real key to this is if, really work with your tax planners, because they brought back net operating loss carryovers. If you end up with a loss this year because of COVID related items, you can carry that loss back 5 years and go get money that you paid the government years ago. So there's a lot of strategy in play here that they really brought back to us by making sure it's not tax deductible.
Welcome to Buzz House, a Baker Tilly podcast where you can find all the buzz around multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Garrett Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Each week, we'll bring you a guest or a topic in the multifamily housing industry that will help you win now and anticipate tomorrow. Let's get started. Today, our guest in the Buzz House is Todd Bernhardt, a partner of ours at Baker Tilly who is a small business leader and is the firm expert in all things Paycheck Protection Program. We'll be talking with Todd today about the Paycheck Protection Program, or PPP, that was part of the most recent COVID-19 relief package. Before having a discussion with Todd about these timely topics, we want to give you a few updates from around the industry, primarily coming out of the Consolidated Appropriations Act 2021, signed by President Trump on December 27th. There are a number of items to unpack in this legislation. We're going to start with a couple of places around the low-income housing tax credit program. Of course, a topic that Garrett and I have been discussing on a number of Buzz House podcasts over the last number of months are the fixing of the 4% tax credit rate at 4%. As many of you know, in December of 2020, it was hovering right around 3.09. So 3.09 to a fixed 4% is a 29% increase in tax credit generated by these 4% deals. A live example of a project that Garrett and I are working on is a new construction project located in a qualified census tract. We're underwriting with a 3.09% tax credit rate. We had about $1.3 million. It was $1.309 million of annual tax credits. All of a sudden, boom, we've got the 4% fixed tax credit percentage, jumping up to almost $1.7 million, so $1.694 million of credits, 386,000 more annual credits. So 3.8 million of credits. You can do the math at 90 cents. We have over $2.7 million of additional equity overnight. So almost 29% more equity into a project. Obviously, the benefits, not having to stress the deal so much. Some cases in rehab deals, you're able to do more rehab overnight. Maybe you're kind of a little bit late in your rehab. Some things people have talked about, obviously, maybe your state HFA, if it's going to have to go through subsidy layering, are you potentially oversourced? How does that look in your pro forma? So kind of be thinking about that. And obviously, the long-term benefits, various projections show over 120,000 new units will be able to be produced over the next 10 years because this is going to make deals feasible that weren't feasible before. Garrett, I know you have a bond roll-up transaction in the Chicago area that really was on the verge of not working. All of a sudden, that's generating significant additional equity into the project that's going to work. So kind of excited to see over the next couple of months, how many more deals are going to be able to move forward. While extremely helpful, the one quick concern that we have, I think the industry has, is back to states running out of volume cap. As you all know, there are probably around 11 or 12 states in 2020 that either ran out or were very close to running out of volume cap, meaning I can't access the 4% credit anymore. So what does this do for me? There's been a lot of discussion again, and Garrett and I have brought it up, that some language out there to reduce the 50% test down to 25%, which would, of course, essentially double the amount of bond deals that could get done. So we think we'll continue to see improvements to the tax code to further enhance the use of the 4% credits. One quick discussion that it's been out there is the question, of course, came up. Well, I closed my deal December 1st, 2020. Am I going to be able to utilize the 4% credit? We believe the legislative intent is everything prospective after December 31st, 2020. A lot of bond attorneys and so forth are digging into that. More to follow. It doesn't seem like it would apply to those, but we're not. The industry is not ruling that out yet, so we'll stay on top of that. A second item affecting low-income housing tax credits that came out of the Appropriations Act were additionally $121 million of additional 2021 9% tax credit authority, which are for these states and Puerto Rico, Alabama, California, Florida, Iowa, Louisiana, Michigan, Mississippi, Oregon, Puerto Rico, Carolina, Tennessee, and Utah. Again, this is for non-COVID major disasters that qualify for FEMA assistance. Any questions on that, you can please follow up with Garrick and I. A couple other really quick items. Of course, many people watching the eviction moratorium, that this legislation extended that through January 31st, while state and governments were quickly distribute aid to those in need, and that primary aid being the $25 billion rental emergency fund that was included in this legislation. It has to be targeted for persons that are or households below 80% AMI, with a focus for those that are 50% AMI. Must also focus on those who are unemployed for 90 days. So be watching, you as property owners, be watching how your state is going to be rolling out those dollars and which agency in your state is going to be deploying those dollars. Again, reach out to us with questions on that. Two last items. New markets tax credits are authorized through 2025. So that was a great piece for the new market tax credit program. And then also, Garrick and I have recently touched on renewable energy tax credits that are being phased out. That's now a 2-year extension at a 26% rate, had been 30%. So, but a 2-year extension on that. So a lot, a 5,000-page bill. Some of these provisions were maybe a short paragraph, but yet very impactful and powerful. So with that, again, very excited to have Todd Bernhardt in the Buzz House today. And we're going to turn it over to Garrick to jump into a discussion with Todd. Garrick?
Thanks a lot, Don. Glad we got that 4%.
Yeah, exactly.
We were definitely looking for that one. Before we get into our discussion, obviously, we want Todd to tell us a little bit about himself and kind of what he does. But basically, he's on here as the firm expert for the second round, the sequel, the Paycheck Protection Program, otherwise people calling it PPP2. It's the second coming, the second round. So, Todd, why don't you go ahead and tell us a little bit about yourself, and then we'll jump right into some sort of questions surrounding the issues or what they fixed on this next round of Paycheck Protection Program.
Yeah, thanks, Garrick. So I've been at Baker Tilly over 20 years now. Seeing Don Bernard's today is a flashback. That's he was one of the first people I met at the firm back then. So it's kind of the good old days. And that's kind of what the PPP feels like some days, where this has never ended. It's just kind of Groundhog's Day. We're starting over again here, and we'll be doing PPP forgiveness applications through probably this time next year. So I lead Baker Tilly Advantage, which is our small business practice. And it's been a whirlwind year for that practice. Kind of started off as trying to identify some needs, and we quickly jumped into this couple of CARES Act, followed by this latest bill. Perfect. So why don't we just go ahead and jump in? Obviously, I'd like to start with just, some general questions, just in case people weren't around for the first round and trying to get some other type of information here. But what kind of entity, going back to the people who received funds in the first round, can an entity who received those PPP funds in the previous round apply again this time? Yep, definitely. So most entities that were eligible the first round are eligible again, subject to some changes. One of the big ones is they lowered the number of employees from 500 to 300. So they're trying to target a little more targeted here with 300 employees. There's also a 25% sales decrease in any quarter of 2020 compared to 2019. So a lot of clients are going back to quarter 2 of 2020 and comparing that to quarter 2 of 19. If you went up in 3 and 4 of 20 back up, you're still eligible. There's some, needs testing that you have to certify to, but that should, most clients are going to qualify on that, 25% reduction in quarter 2. And some went down different quarters, but, that's the first thing I think people are looking at. They added in a few new wrinkles. They brought in 501c6 organizations. So I don't know if we have any out there in the audience, but everybody knows one. So your chambers of commerce, your trade associations, they were all left out the last round. So they can go get a first round of PPP. The regulations aren't out yet, but based on the bill, if you didn't get PPP the first time, it seems like you can go get it again, or you can go get it for the first time and potentially apply for PPP2 right away. So we know a lot of smaller entities out there maybe didn't have a great banking relationship and didn't get any PPP the first time. So there's a lot of different funding options out there this round that hopefully is going to help out some of those businesses.
Yeah, that's definitely, an additive to this whole process here that I read about. It was quite interesting. So knowing that, now that you got obviously even more folks that can come in here and do either first or second round, how much can someone actually apply for?
Yeah, so the max loan for most people in this audience is going to be $2 million for the second round. They're eligible for up to 10 last round, so they lowered that. They're trying to make sure more people get it, more targeted people. There's some exceptions in the hospitality industry where they'll be able to get some more. They get a little larger loan, 3.5 times. So if you're doing developments for anyone in that space, but the average developer is going to get 2.5 times their average payroll. So $1.2 million payroll is $100,000 average payroll, $250,000 PPP loan. You can go back to 2019, which was a big ad because we had a lot of people worried that, yeah, that's great. I can use my 2020 payroll, but it's down 30%. So you can actually go back to 2019 and get as big of a loan as you got the first time. So it's going to be real stimulus for a lot of businesses here.
That's great. At least it sounds like they've kind of got their act together and it's kind of, they understand where those pressure points are. So given that, so what are the general rules for the use of these funds?
Yeah, so like last round, the goal is payroll, right? So 60% of your loan needs to be used for payroll. And that includes, benefits, insurance, guaranteed payments, stuff like that. The other 40%, initially was utilities, rent, and mortgage interest. And they got a lot of pushback that, we have a lot of other costs to keep a business going than just paying our landlord and paying the bank. Well, they added in a few other categories. Supplier costs was a big one that, it's pretty broad, I would say, of what you can include as a supplier cost, but also any costs you had to upgrade your cloud computing, whether for working remote or adding a online ordering platform qualifies, PPE costs, masks, that sort of stuff. That all got brought in. The other one that they threw in there as an eligible cost is if you had property damage due to some of the rioting that might have happened. So if you're in a downtown area and you got your windows smashed, that qualifies as a cost as well. So to me, it won't be hard if you're someone in business to find a lot of these costs this round. I think that was a challenge for some people, and especially if we can get back to offices opening up and stuff, I think it'll really help some of the businesses out there.
Definitely. So that's, surrounding the sort of use of funds. And I know there were some issues around like the actual business expense deductions, et cetera. So, and forgiveness always comes up, right? So what are actually the general requirements for forgiveness? Because I know it seemed a little more confusing last time, but based on this legislation and what we know from the first round, what are those sort of general requirements?
Yeah, really the general requirements is if, you take $1 million loan, you got to spend $1 million on the eligible costs we talked about. Now, it's not as easy as that because 60% has to be payroll and you have to maintain your full-time equivalents. And that's been the biggest challenge of figuring out that number and the supporting documents. And frankly, the banks hate this process because they might have a loan for $100,000 or even $25,000 and they get a stack of paperwork. So one real benefit of this bill, and I think it was pushed by a lot of the bankers and small businesses, is under $150,000, they're coming out with a new one-page forgiveness application. So, the over 2 million guys are still going to go through all the same hoops, but the smaller taxpayers are going to get a little easier process here, and they can submit a one-page document. They have to keep their documentation, in case of a, SBA review, but they don't have to, give it all, and the banks can turn this around a lot quicker for people. So that's going to be a big help.
Yeah, I guess with that, it seems a common theme that this process has now gotten a little more efficient than it was there before. So given those efficiencies, what is the timing of the PPP?
Yeah, so little background. Right after Christmas, it was signed by the president after a little back and forth on some of the throw-ins in there, but it's signed. The regulations and a draft of the application came out after the new year. They dropped the application late on a Friday night, I believe the 8th. So now the Treasury's, we're still working with Treasury on questions, but we have regulations and we're going with that. During the week of the 11th, the SBA was testing their systems. They opened up to some very small lenders and underserved borrowers. Some applications may have went through that week, but very minimal. And the SBA system went live, supposed to be on the 15th. On that Saturday, they finally started getting some loans approved. I believe there's a lot more issues with the technology this round. So banks are, scrambling right now to get everything set up because they have to electronically submit versus hand key. So applications are being submitted already on the 19th, which is after Martin Luther King Day. All the big banks are going to be available to start submitting. So as of today, only banks under $1 billion are allowed to submit. And I think from my intel, there haven't been a lot done outside of fintech. So something to keep an eye on as we keep going here, but things are live right now.
Yeah, I mean, and I remember, and maybe you did too. I mean, it seems to me like it was rolled out pretty quick last time. And I know sometimes you watch the news and of course you hear that there was some fraudulent applications. What do you think? I mean, you think in this sort of round we'll have the same thing happen or have they kind of figured it out?
Yeah, well, I mean, a little bit. I mean, what they lowered the standard, at least some of the people who got the money, the Shake Shacks were in the news, right? They didn't want a public company going to get a $10 million loan. So they've taken public companies out of there. They lowered the number to 2 million. So in theory, those guys aren't going to be getting it. The fraud is out there. So a lot of the fraud came with smaller companies trying to get on these platforms, as these fintechs were loading up. Well, these fintech banks, think BizCredit, Cabbage, Intuit, they've upped their security. They're working, actually BizCredit's working with our firm in the AICPA. So they have a CPA on the front end to get funded. So they're trying to prevent some of that fraud that's been out there. I'm sure people are going to, any process like this, they're going to try to, go after some fraud, but hopefully it's going to be mitigated. And I know they have already said there's a few more identity checks in the system that the SBA's learned from. So, we should see that come into play.
I think Don has a question he wanted to ask too, but I have one more. What about like the sort of the tax deductions on, that?
Yeah. So the big fight for months was back in March of 2020, when the bill was signed, Congress always said that this was going to be tax-free money to the taxpayers. Well, that IRS came out quickly after, and they said, yes, the loan is tax-free. However, tax-exempt interest means you can't deduct the related expenses. So if you took out a loan for $1 million and you used $1 million of payroll to get your forgiveness, the IRS came out and they actually doubled down later and said you couldn't take those deductions. With this bill, Congress trumped that and they said, no, the intent was you're not paying tax on this money. So that's a huge win for, the taxpayer, especially the businesses hardest hit. They were really going to, they used all their money and they're still struggling. They're really going to be having a hard time paying that tax bill come April. So that's not going to be happening. So, a real key to this is if, really work with your tax planners, because they brought back net operating loss carryovers. If you end up with a loss this year because of COVID related items, you can carry that loss back 5 years and go get money that you paid the government years ago. So there's a lot of strategy in play here that they really brought back to us by making sure it's not tax deductible.
It always comes back to tax. I think Don, you had one question.
Todd, one final question for you today. For our listeners out there, again, this might be new for them. Maybe they're first. What kind of services can Baker Tilly, Todd, you and your team provide around this? Yeah,
so I'd say there's a wide range. I mean, from basic Q&A questions. I think the first step is understanding if you're eligible. So helping you understand the different requirements is kind of the first step. Now that's gonna be a lot quicker than it was back in March. That was probably 2 weeks worth of nonstop phone calls. And then really it's trying to help you get funded fast. There's a couple options. I mentioned AICPA and we partnered with them for a portal. And so we can help clients get funded through that. And they can either, we can take them from start to finish where they can get funded with BizCredit, which is a AICPA endorsed partner, or we can help them organize all their information, complete the application, and then go take it to their bank. So there's a few different options. Because what we learned in the last round was certain banks were ready to go, and for certain clients that were ready to go. Not all borrowers out there are number one in line with the banks. So this is a way we can help smaller borrowers and larger, but some of the people who might had a hard time finding a bank last time, we can get them funded through a couple options. This is one of them. We have a couple other banking relationships that we sent people to last time. So I would say if you're talking to their banker, you're worried they're not going to be ready, we can help you get ready. We're loading people in our portal now, even before the application's written. So it should be a wild, I'd say 2 to 3 week process here as soon as the application comes out. So we're here to help.
All right. Thanks, Todd, for joining us here on this episode of Buzz House. And with that, that's a wrap. And listeners, thank you for tuning in today.
Thank you for listening to Buzz House. To receive a notification when new episodes are available, please subscribe to Buzz House, a Baker Tilly podcast, wherever you get your podcasts. For additional resources around multifamily housing, check out bakertilly.com. And if you have a suggested topic, please send them to build@bakertilly.com. That's BUILD@bakertilly.com.
The information provided here is of a general nature and is not intended to address the specific circumstances of any individual or entity. In specific circumstances, the services of a professional should be sought. Tax information, if any, contained in this communication was not intended or written to be used by any person for the purpose of avoiding penalties, nor should such information be construed as an opinion upon which any person may rely. The intended recipients of this communication and any attachments are not subject to any limitation on the disclosure of the tax treatment or tax structure of any transaction or matter that is the subject of this communication and any attachments.